Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is October 5th, 2025, and we are looking at an absolutely monumental move in gold, XAUUSD. The news cycle is buzzing, with headlines dominated by the ongoing U.S. government shutdown and widespread speculation about two more Federal Reserve rate cuts before the end of the year. This combination of political uncertainty and dovish monetary policy expectations has created a perfect storm for the precious metal, sending it soaring to fresh all-time highs. Multiple sources confirm this massive record-shattering bull run, with prices smashing through previous resistance levels. However, after touching the rarefied air near $3,900, we've seen some sharp profit-taking, raising questions about whether this rally has run out of steam in the short term. Looking at our daily chart, the long-term picture is unequivocally bullish. We can see a powerful, sustained uptrend that has been in place for over a year, taking price from the low $2,300s all the way to where we are now. This isn't just a short-term spike, it's a structural bull market underpinned by central bank buying and investors seeking a hedge against inflation and a weakening dollar. Notice the key psychological levels that were broken along the way, such as $3,000 back in March and $3,500 in early September. Each of these breakouts was followed by a period of consolidation before the next major leg up, which is a classic sign of a healthy trend. Now, let's zoom in on the action from the last month. This is where the story gets really interesting. As you can see, the ascent became almost parabolic in late September. This acceleration directly correlates with the escalating political turmoil in Washington as the government shutdown became a reality. The market began aggressively pricing in the probability of Fed rate cuts, viewing the shutdown as a factor that would force the Fed's hand to remain dovish. This surge took us from the $3,700 level to nearly $3,900 in just a matter of days. To understand the recent rejection, we need to switch to the hourly chart. Here we can see the anatomy of the blow-off top that occurred around October 2nd. Price reached an intraday peak of $3,896, falling just shy of the $3,900 psychological milestone. What followed was a swift and aggressive reversal, with price plummeting over $70 to find support right around the $3,820 level, a key area mentioned in recent market reports. This is a classic example of exhausted buyers and heavy profit-taking at a significant resistance zone. The daily candle from that day formed what some analysts are calling a reversal top, which often signals a potential for a near-term correction. Drilling down even further to the 15-minute chart gives us a granular view of that reversal and the subsequent battle. You can see the intense selling pressure that came in right after the peak. However, watch how buyers stepped in aggressively at that $3,820 to $3,825 support zone. This area, identified by some as a fair value gap, provided the floor for the initial decline. Since that low, the price has been consolidating in a range, showing indecision in the market. The bulls who believe in the fundamental story are buying the dip, while bears are testing to see if they can push the price lower and trigger a deeper correction. Returning to the daily chart, let's recap the critical levels we need to watch. The immediate and most significant resistance is the recent high, anywhere from $3,890 up to the psychological $3,900 level. A clean break and close above $3,900 would signal a continuation of the uptrend and open the door for a move towards $4,000, a target forecasted by major banks like HSBC. To the downside, the first line of defense is that crucial support zone between $3,820 and $3,835. This level has already proven its strength. If it fails to hold, the next significant support is the round number at $3,800. A break below that could signal a deeper correction, with potential targets at the swing lows around $3,750 and $3,742. So, what can we expect moving forward? Let's outline two unbiased scenarios. The bullish scenario, which I believe has a high probability, relies on the fundamental drivers remaining in place. As long as the U.S. government shutdown continues and the market expects the Fed to cut rates, the path of least resistance for gold remains upward. Look for price to consolidate before retesting and ultimately breaking the $3,900 resistance. Conversely, a bearish or corrective scenario has a medium probability in the short term. A catalyst for this would be a sudden resolution to the shutdown or unexpectedly hawkish comments from Fed officials. A confirmed break below the $3,820 support would be the technical trigger, likely leading to a pullback toward the $3,750 area before long-term buyers step back in. In summary, keep an eye on resistance at $3,900 and support at $3,820. The fundamental news out of Washington will likely dictate which level breaks first. This has been your in-depth look at XAUUSD. As a final note, please remember that this video is for informational purposes only and does not constitute financial advice. You should always conduct your own research and analysis before making any investment decisions. Thanks for watching Explain the Charts.